Welcome to Open for Business, the Gallatin Valley's only local business and consumer talk show featuring Tom Egelhoff, the Man Entrepreneur magazine radio called the leading authority in the United States for doing business in small town. Here he is, speaker, author, small business consultant, and Mrs. Egelhoff's favorite son, Tom Egelhoff.
All right, welcome everyone. Open for Business. We air every Saturday live from 11 a.m. to 2 p.m. Mountain Time on AM 1450 KMMS in Bozeman, 1340 KPRK in Livingston, Montana. If you'd like to be a part of the big broadcast, go to kmmsam.com and click Listen Live. The call-in number during the show, 406-522-TALK, 406-522-8255. I'm here, you're here. Let's get the show on the road. All right, 25 minutes before the top of the hour. It is Saturday, December 3rd, 2016. Welcome to the podcast portion of Open for Business. Each week I share some tips and tricks I've learned over the years about advertising, marketing, promotion, and building strong, successful businesses. And if you missed any of my previous podcasts, you'll find them all on my YouTube channel. And while you're there, why not subscribe to my YouTube channel? You'll never miss another weekly podcast. You'll also find my podcasts on my website at smalltownmarketing.com. That's smalltownmarketing.com. Today's topic, we want to talk about financial statements, how to read and how to profit from them. Now, the basic rules of baseball haven't changed much in nearly 100 years. It's still 60 feet 6 inches to the pitcher's mound. Bases are still 90 feet apart. 3 strikes, you're out. 4 balls, you walk. But what has changed is how the game is coached and managed. In the old days, when someone came up to bat with men on base, you crossed your fingers and hoped the pitcher could get them out. Today, the manager not only knows the batter's average, but his average with 2 outs and runners in scoring position. He knows how the player bats against right-handed and left-handed pitching, and a host of other stats about every player on the opposition as well as his own team. Now, the same is true in business. Your financial reports provide information about your business that you should be using whenever you make the financial decisions. However, the sad fact is most business owners only look at a financial statement twice a year. They look at the annual profit and loss statement, did we make any money, and their taxes. How much of our gross income do we have to pay? So today I want to show you how different parts of your financial statement can affect your business. First, what kind of information are we looking for? We're going to look at numbers, ratios, and percentages and how each affects your bottom line. So in order to know if your numbers, ratios, and percentages are favorable or unfavorable, you need something to compare them to. Now, most associations will have these base numbers for your industry and formulas to calculate them. Your numbers may vary in size because of from the average, because your location, your city size, your company size. Now, if you aren't sure of your industry numbers, you can contact the nearest SCORE chapter or the nearest Small Business Development Center. Ours is out at MSU. They have listings of associations and ratios for most businesses and industries. So let's start with the cost of goods sold. This is the cost of sales and the cost per customer. Cost of goods is producing, converting, or buying an item that is sold. Formula is very simple. Take total sales of all products and subtract the cost of goods along with all overhead, and the difference is your gross profit margin. Now, this should be done on an overall basis and again for each product. The individual process will show which products are winners and increased inventory might be considered, or which are losers and should be eliminated from your stock. Let's talk about return on sales. How much do you make on each sale? Another gauge of your business is how much does it cost for a customer to buy a widget from your business? So how much does each sale cost and how much do you make? You'll need your profit and loss statement for this one. Return on sales will show you the percentage you make on each dollar of sales, and here's the formula. You'll divide your net pre-tax dollar profits by total sales. The beauty of this formula is it measures in percentage how efficiently you convert a sales dollar into profit. Cost-benefit analysis. Should you or shouldn't you? Ever get an idea and wonder if it'll work? Well, the cost basis analysis will help you make that decision. Suppose you have an auto parts store and you'd like to expand to other cities. If the cost of expansion outweighs the income produced by each store, then the move is probably not a good idea. Have you ever had a recall on a household appliance? Companies often have to weigh the cost of the recall versus the cost of customer goodwill, lawsuits, and customer confidence. The recall may cost the company more in the long run if they don't do it than if they do. Now, could you make more money someplace else? How much do you have invested in your company? How much are you taking out of the business? Salaries, bonuses, and benefits can have a major impact on any business. So start by dividing your pre-tax dollars from your P&L by your equity or net worth on your balance sheet. This will show you your return on your investment. If it's less than 5%, you might be able to make that with a good investment somewhere else and stop working. If you like what you're doing, keep doing it. If not, stop working and start living. Now, how often do you turn over your inventory? If you're a retailer or wholesaler, you got to move inventory. How much tells the health of your business and how well you're managing your inventory. So to calculate this, divide your average inventory into cost of goods sold from your P&L. The higher the number, the more turns you have and the healthier your business. Accounts receivable. If you're in business, you must be paid in a timely manner for your goods and services. Slow pay can put you out of business. You must have a handle on how quick the money comes in. So the first step is to compute your average sales day. So if you take your total sales for the year and divide by 365, if you're open every day of the year. If you're not, compute the number of days you are open for business. Next, divide that number into your current accounts receivable. This will show you the average number of days it takes for you to collect from your accounts receivables. Less than 30 days is preferred. 30 to 45 is acceptable. Almost anything over 45 days may cause a hardship to your business. Learn to do it yourself. Counting is a lot like practicing medicine. The patient comes in, put on the heart monitor, take blood and other fluids for testing. Then a doctor reads and evaluates the tests and arrives at a diagnosis. The patient is either in trouble or the patient is healthy. And no, I don't want you to do your own accounting. Most businesses need an accountant just to keep them out of trouble with the IRS. What you should do is learn how to read your financial statements so you know what's going on in your business. Otherwise, you'll start making decisions and creating problems, and your accountant is going to have to try to bail you out. And they may not always be successful. And that's the podcast. If you missed any of my previous podcasts, you'll find them all on my YouTube channel. And please subscribe to my YouTube channel or on my website at smalltownmarketing.com. That's smalltownmarketing.com. Go about halfway down the homepage on the left side, and you'll find a link to the podcast page so you can catch up on any of my podcasts that you might have missed. So tune in each Saturday, and let's build successful businesses together.